if we lose dollar reserve status, it sends us into an absolute tailspin. The reason that we're able to just continue to print is because everyone has to trade in US dollars. International trade between Ireland and the UAE happens in dollars for the most part. And so people are constantly buying our currency or buying our treasury in order to fund the international exchange that they're taking place with. If that goes away, we can't continue to print.
All righty, folks, I would not be doing my job if we didn't talk about Ray Dalio's comments over the weekend. He said, and I quote, "I'm not worried about a recession. I'm worried about something worse than a recession. I am concerned about the global monetary system breaking down." Taylor, you've been on Wall Street for 12 years. You work with the top 1% of the 1%. What is Ray Dalio really telling us? And what are your thoughts?
So Ray is one of the brightest minds in the past half a century when it comes to investing, economics, capital markets, etc. So
portfolio when he says construction.
Yeah. Oh, portfolio construction, he's second to none. We can discuss that in a minute. But when he says this, you got to take it seriously. I will say that he is a bit of a broken record when it comes to this topic. Ray has been incredibly, incredibly concerned for a number of years with the national debt and the printing press that we continue to turn on. So either Ray has unfounded concerns or Ray's concerns just haven't come to fruition yet.
He might have been early.
Yeah, he's either early or he's wrong. And we'll find out only in hindsight whether he's early or he is wrong. But he is very concerned about the perpetual nature of our country and countries abroad to continuously print money in the face of, the nasty environment that we're in. Our solution every time is just print it.
Yeah. Well, I think Ray Dalio is actually going deeper than that. He's starting to talk about kind of the four things that are happening in the environment, almost Civil War level infighting in our own country, right? Blue hates red, red hates blue. And, anything a blue does is bad, all that nonsense. So he's highlighting that as a big risk factor. He's also highlighting, obviously, the China-US trade war. And that's what I think has really put him down this path. I think he's looked at the tariffs, the kind of all at once, the chaotic rollout. And in his mind, I think what happened is, in his mind, this concern he had is this is the event. And now he's like, worst case scenario, right? He's talking about the freaking monetary system breaking down. Yep. I can't even fathom what that would look like.
Yep. You're 100% right. And one of the things that Ray has been preaching about for years now is just the wealth inequality. And his point on this is the printing press that continues to be turned back on leads to those that have investments in the market continue to get buoyed from a bottom-up perspective by the government printing and spending or giving to us to spend. And what it does is it perpetuates this wealth gap that it gives this growing disparity. And that's a lot of where he comes with the civil unrest conversations. And he's not wrong. He's bombastic. Is he wrong is up for debate at this point. And again, his thoughts haven't come to fruition, but it doesn't mean they can't.
No. Again, I think you're right. I think your context, is he wrong or is he early, is very fair. And I will say that there are more signs that he is his concerns are valid, right? Some of the stuff that he's been talking about for 5 or 6 or 7 years really fell on deaf ears. But if you kind of take the context of the last 12 months, certainly the last 6 months, you're like, gosh, I could see what he's talking about.
Yeah. And it's interesting. We have not a ton of international clients, but we have international clients both in Canada and in Europe, and then 1 or 2 in Southeast Asia. And it's funny to get all of their different interpretations of what they think about our stance now. And what has come up is some of them are understanding. I would say 50% of them are just understanding. And then the other 50% are pissed off. And they look at this as we've been, like the Canadians that we have as clients, they look at this and they say, we've been good partners to you. Like, why are we getting slapped right now?
Yeah. Yeah, it's really interesting because one of the things that I put out there in the last, since Liberation Day that's not being discussed about is we're damaging the U.S. brand.
Correct.
right? Where we've gone after everybody with everything, and the fact that we call these reciprocal tariffs, which is complete nonsense, right? They are not reciprocal tariffs. They were some
Correct.
trade imbalance calculation,
Correct.
totally miscommunication.
Correct.
Um, I That's where I think this thing can get really bad, right?
Yep.
If we really damage the brand going forward. It's funny. I think about the NFL. They always talk about valuing the shield, right? The NFL shield,
Yep.
right? Do everything that's paramount to number one. I really think the U.S. brand is damaged. We're already seeing in travel data. I don't know if you've seen the charts. You probably have, where
Yep.
travel from many European countries is down 30%.
Yep.
I'm going to be interested with Q2 earnings. So again, we're 90 days away, 100 days away. If we're going to see foreign demand for our goods like Nike and Starbucks and other U.S. brands just take a nosedive from
Yep.
foreign countries. This could be a massive problem. It will damage earnings. International companies can get 50% of their revenue and profit from overseas. If that
Yep.
falls, we got a
Yep.
problem.
I think one of the things that you're highlighting here that has been going back to one of our other videos, just talking about the miscommunication that's come out of the administration on this, is you just went back to the formula that they had to generate what our tariffs that we're paying are. And that was all predicated on, to your point, trade imbalance. So it was a very kind of convoluted way to essentially end up with, hey, are we buying more of their goods? Are they buying more of our goods? And at the end of the day, like, we need to be, and this is nerd stuff, but I get it. We need to know this nerd stuff. Are we targeting trade imbalances? Or are we targeting unfair trade? Because
Right. It's
we are
different.
the larger country. We
Yeah,
are
and
going to purchase
we're
more
the
from
consumer.
most folks.
Yeah,
Yeah,
exactly.
that's how it works. Our economy's bigger. We have more money to spend on others' goods than they have to spend on ours, and vice versa.
Mhm. Yeah. But going back to Ray Dalio's concern again,
Yep.
when you think about the monetary system breaking down, I've been thinking about this for a while because I knew that you and I were going to talk. And when I try to put that big scary headline into littler pieces, to me, one of the things that happen is the dollar loses reserve currency or at least gets an equal. Maybe
Mhm.
it's BRICS, maybe it's something else. Maybe it's debt default. You know, we've heard for years that there's going to be this massive Bretton Woods debt default or whatever, is called. I mean, when I think about what a monetary system breakdown looks like, those are the only things I can think of. But what else could happen?
I think the dollar is the big one, right?
Okay.
So if we lose dollar reserve status, it sends us into an absolute tailspin. The reason that we're able to just continue to print is because everyone has to trade in US dollars. International trade between Ireland and the UAE happens in dollars for the most part. And
Mm,
so people are constantly buying our currency or buying our treasury in order to fund the international exchange that they're taking place with. If that goes away, we
mm,
can't continue to print. And then what
right.
happens is our debt servicing costs explode, because if we don't have that natural foreign buyer and buyer domestically and foreign, what happens is you take a 10-year treasury from 4.25, 4.5, where it sits today, to all of a sudden then it goes to 6, 7%. And every 1% movement in our 10-year treasury costs us at this about 300 billion in debt servicing per year, or 3 trillion over a decade. So if you get a
Yeah.
move upward of 2%, which, if we start to get the chinks in the armor and that starts to play out, then bang, you have our debt servicing, double. Like, that's crazy to think, but that's the reality of how quickly it can move.
Yeah, the last thing kind of running on this again, back to Ray Dalio pointing at some things that was concerning to me on Friday. So even before Ray spoke, or at least before I heard what Ray said,
Right.
was the fact that the US dollar was acting like a third world country, an emerging market. And what I mean by that was rates went up noticeably and the dollar got weaker. Dude, that's not supposed to happen.
That's not good. That's not good.
That's
Yeah. But at the same time, in periods of exogenous events, correlations come apart to their typical norm. So
sure.
I think we are looking at things under a hyper microscope right now, and broaden things out, like even more broad asset class wise. So like, you had stocks selling off and US treasuries selling off simultaneously.
Yeah.
That doesn't
That
happen. When
doesn't
stocks
now.
sell off, people buy treasuries because they're a safe haven asset. What happened there was, you had, I think, a confluence of a couple events. You had foreign governments that stepped in and they said, hey, we don't want these tariffs. And one of the combatant tools that we have to do so is just to dump some treasuries onto the market,
Mm.
cause their debt servicing to go up. That will back them off a little bit. And it did. Trump, I honestly think that was the largest
Oh yeah,
component of
Very,
why Trump pivoted was just,
no
hey,
question. The 30-year
rates backed
pop
up.
to 5%. Oh yeah, that
Yeah. And
came on.
so that happened. And then just when you get a leveraging squeeze, which is a deleveraging squeeze rather, which is what we experienced, people don't just sell stock. They sell anything they can get a good price on. And so
Yeah.
you had that massive treasury purge happening from hedge fund leveraging. So
Mm.
again, these wonky events happen. Broadly speaking, like there is some argument to be made in short term that a weaker dollar helps. You know?
No question. But it's the weaker dollar and the higher rates.
Oh yeah. No argument that we don't want that scenario playing out.
That's not
100%
good.
correct there.
Yeah.
Yes.
No,
You're right.
I agree. A weaker dollar would be, frankly, a welcome reprieve. It would actually make the tariffs less painful.
Correct.
So again, I like the point. Again, this was a very much a micro focus. It was over 3 or 4 days, but anything that gets that wonky, and then Ray Dalio comes out. So would it be fair to say that if this continued for a month and certainly a quarter, where the US dollar got weaker as rates went up, then it would be a red alert?
Sorry for my smirk because this is not a funny topic, but I just love your constant ability to peg me. Peg me on something. And not just me, your other guests as well. But you also peg yourself on stuff. So credit to you on that front. Yes, if we see this trend perpetuate, it will highlight bigger problems in the foundational structure of our country. No doubt about it. If you have continuous dollar weakening against strengthening interest rates on the other side, there is no way to look at that but an ominous canary in the coal mine type scenario. And I think it's all going to depend on the degree to which the magnitude of the moves, kind of take place, and the rapidness, if that's a word, would be kind of where the concerns come in.
Yeah, a couple of weeks ago we were talking about this, and we were giving Scott Besson some flowers, right? He was focused on bringing the 10-year note down. It got down as low as 3.9 or 3.91. It's not there today. I think it is down a little bit today, but do you still think his goal is the 10-year note, given all this short-term debt that Janet Yellen left with him to roll over?
I wonder where Scott Besson is on a lot of this stuff. Scott Besson is a true billionaire that made it in the markets, that understands economic policy really, really well. I am very curious to know whether he is actually believing what he is now saying. And I know I'm not answering your question directly, but it's a bigger thought that I have of like, does he actually believe that, hey, we can do this tariff effectively, et cetera, and here's the marching orders to get us where we need to be? Or is this Lutnick in his ear? Is this Navarro in his ear? Is this Trump in his ear, forcing him in the direction to, kind of do things in their model? I don't know the answer to that. To state the obvious, it'll be interesting to see how it plays out. But on Besson's topic, like, yeah, we had a reprieve in coming down of rates. That was fear. That wasn't a good reprieve in rates.
Yeah.
That wasn't a good reason. I will say the one thing that, and this is fear driven too, so I guess I'll immediately take it back. But like the one big positive that's come out of this is oil. And I don't necessarily think that you can say it's deregulation that's driven oil prices down. I think it's fear
of a recession.
It's
fear of a worldwide recession.
Correct.
Yeah, that's what oil's telling us.
I don't think that that's been a success, if that's kind of what we were getting at there. I don't think that Besson's positive spin on this is actually what's playing out. I think it's fear.
Yeah, so I guess my question really is, do you think Scott is hyper-focused on the 10-year note because that's the debt he's got to refi? Do you think that?
I think I do think that it's important to him, but I think that is going to be the poster child of, okay, if we can't focus on the market, we'll focus here and we'll toggle back and forth in this political paddle game that we're playing right now. I don't necessarily think that is his end all be all, but there is a knock-on positive effect of fear in the market. And it's the fact that we can finance debt more cheaply.
Well, at the end of the day, folks, we get the pleasure of talking to a 12-year Wall Street vet, and somebody works with the top 1% of the 1% each and every week. Taylor, where can they find you?
Yeah, find us on Instagram, on TikTok. Do daily clips there, and we're at Life Goal Investments.
Go look it up, folks. Life Goal Investments, 60 seconds. You won't regret it. Later.
Thank you.